Hello and welcome to Lecture 9, where we'll be discussing non-tariff barriers to imports. In Lecture 8, which was covering Chapter 8 of the book, we talked about tariffs, trade tariffs, and the economics behind those. And now we'll talk about some additional barriers to imports that are non-tariff barriers. This covers Chapter 9 of your book. So protecting domestic producers against import competition clearly helps those producers, but it harms domestic consumers of the products. We saw that with tariffs, producers gained and consumers were harmed. And based on what we saw in Chapter 8, consumers are harmed more than producers gain. So it probably hurts the importing nation as a whole, and almost surely hurts the world as a whole as we look at protecting domestic producers. So a non-tariff barrier, or NTB, to imports is any policy used by the government to reduce imports other than a simple tariff on imports. So anything that the government's going to use that's not a tariff to have a barrier to imports is what we call a non-tariff barrier to import. An NTB reduces imports through one or more of the following direct effects. First, limiting the quantity of imports. Second, increasing the cost of getting imports into the market. And third, creating uncertainty about the conditions under which imports will be permitted. This is a table, figure 9.1 in your book, that shows the major types of NTBs. And so as we look over here, we can see the type. There's a description of it, as well as the direct effects. So for instance, import quota, which we'll talk about here in a little bit. Description is quantitative limits on imports. And so the direct effects is it'll affect the quantity of imports being allowed into the country. We've got voluntary export restraints, tariff quota, government procurement, local content and mixing requirements, technical and product standards, advanced deposit, import licensing, and other customs procedures. And so here are the descriptions. I won't read through them all. I recommend you pausing the video or going to figure 9.1 to get a deeper understanding of each of these. But these are non-tariff barriers to imports. Okay, so let's talk a little bit more about import quota. An import quota is a limit on the total quantity of imports of a product allowed into the country during a period of time. So it limits the number of imports that can enter the country. Reasons why protectionists and government officials may favor these quotas. A quota ensures the quantity of imports is strictly limited. Once we hit that number, no additional imports can enter into the country. It gives government officials greater power over imports. So here, and this is figure 9.2 in your book, it shows the effect of an import quota under competitive conditions. This is for a small importing country. Okay, so we see in section A of the figure is the US market for bicycles, and B is the market for bicycle imports. Okay, so this is the entire market, including imports. This is just the import market. So we see the demand for bicycles in the US and the supply for bicycles in the US without free trade or trade of any sort. This would be our equilibrium point, and this would be how many would be produced and at a higher price than this 330. Okay, so when we introduce free trade, we would settle in on the world price of 300, where producers in the US would produce 0.6. The demand in the US would be 1.6, And so the difference between 0.6 and 1.6 would be the amount that is imported without quota. However, as we look at this, the way the quota system works, we've got the amount supplied, and then the US, if they allow or impose an import quota, the supply can only go out to this line. This is what the US can supply plus the quota amount. Okay, so as we move down this line, it shifts the total supply line to this point. Okay, so now we've got the amount supplied at that price and the amount demanded at that price of 330. So this is a domestic price with the quota. And so we can see now the amount imported is the 0.8 to the 1.4. And so we've got 0.6 million bikes per year imported. We can see very similarly on the other side, we've got the quota amount here, the world price versus the domestic price with the quota. Okay, so similar to what we saw in chapter 8 with tariffs, you can see that the cost to consumers is A, B, C, and D. So this is the increase in price from 300 to 330 costs consumers. And you can see here that producers gain A. However, there's a question here. With tariffs, this C section went to the government, and sections B and D were a loss. It made the US worse off. But C was collected, the tariff was a tax on imports. And you can see now, though, if we've got an import quota or other non-tariff barriers, the question will be, who gets C? Is it the government? Is it some other stakeholder? So let's discuss this a little bit more. So what are the effects of a quota? Higher price and larger production quantity. So domestic producers gain surplus equal to area A, as we saw. A higher price and smaller consumption quantity in the US, so domestic consumers lose surplus equal to area A, B, C, and D, as we discussed. So area C is the import markup revenue, the difference between the world price and the domestic price for each unit imported. And that was as a result of the quota. So area B and D are losses to the country, as I just mentioned. So area C, how is it allocated? So ways to allocate the import licenses. And we'll discuss these in a little bit greater detail. There's fixed favoritism, could be an auction, or a resource using procedure. So let's define these a little bit more deeply. Fixed favoritism. This is when the government allocates the licenses for free to importers using a rule or process that involves almost no resource costs. So it doesn't cost the government to allocate it, or almost no cost to allocate it. But the government can then have a fixed favoritism based on the way they allocate it. The government simply assigns the licenses to firms and or individuals without competition, applications, or negotiation. The firms or individuals who receive the import license would then get area C. They would be the ones that would benefit, and it would just be given to them by the government. Now with an auction, the government can run an import license auction, selling import licenses on a competitive basis to the highest bidders. The government in this case, of course, gets C, and it's whoever the highest bidders are will pay the government that import license fee. Now for resource using procedures, instead of a fixed favoritism or an auction, the government can insist that firms and or individuals that want to acquire licenses must compete for them in some way other than simple bidding or bribing. So the resource using application procedure would include allocating quota licenses on a first come, first served basis, on the basis of demonstrating need or worthiness, or on the basis of negotiations. So those seeking the licenses use resources to try to get them. So that's why it's called the resource using application procedure. So there's an application that will require resources of those seeking those licenses. So the resource costs indicate that some of Area C is a loss to the country. Okay, another non-tariff barrier to entry is what we call voluntary, and that's a funny word to use, voluntary export restraints, VERs. So it's an odd-looking trade barrier in which the importing country government compels the foreign exporting country to agree voluntarily to limit its exports to the importing country. So while it is technically voluntary, they are compelled if they want to participate in that domestic market. So the foreign exporting countries or country has to agree to the voluntary limits. So the export restraint usually requires that foreign exporting firms act as a cartel by restricting sales and raising prices. So they have to self-regulate at that point. Area C is captured by foreign exporters, so it is a loss to the importing country. So our foreign exporters, the ones that voluntarily restrain the amount of imports coming into the domestic country, they're the ones who will capture C in that example. Other non-tariff barriers include product standards, domestic content requirements, mandates that a product produced and sold in a country must have specified minimum amount of domestic production value in the form of wages paid to local workers or materials produced within the country. So this would require that they use materials and or labor within the production of the product from the domestic country. Product standards could be specific standards that make it hard for other foreign companies or producers to compete or to meet the standard. And so it would favor the domestic producers. Government procurement is another one that we can look at as well. So governments are major purchasers of goods and services. One estimate is that government purchases of products that could be traded internationally amount to close to 1/10 of all product sales in the industrialized countries. So government procurement practices can be a non-tariff barrier to exports if the purchasing processes are biased against foreign products, as they often are. So governments can favor domestic and often are required to favor domestic producers of products. So how big are the costs of protection? How big cost is it? And as we saw, it's usually the consumers that are the ones who are hurt. Well, we can look at what we call the net national loss as a percentage of GDP. I will not test you on this. I'm just presenting it to you so you're aware of it. So we've got the net national loss as a percentage of GDP. It equals 1/2 times the tariff rate times the percent reduction in imports times the import value over GDP. So this is the way you would calculate the net national loss as a percentage of GDP. So why this may underestimate the true cost of a tariff. There may be foreign retaliation as a result of a tariff. There may be enforcement costs in the domestic country, rent-seeking costs or rents to foreign producers, as well as innovation reduction. So while we can calculate an estimate of the net national loss, it's most likely underestimated because of these causes. Finally, we're going to end on discussing the WTO, the World Trade Organization. The World Trade Organization formed global rules of international trade. It was established in 1995. There are 161 member countries as of July 2015, about 20 more countries negotiating for membership. So there are 20 countries trying to get into the WTO. It succeeds and subsumes an earlier agreement from 1947 called the General Agreement on Tariffs and Trade, GATT. So WTO sort of overtook GATT and replaced it. The WTO or GATT principles are to liberalize trade restrictions and move towards free trade, non-discrimination among countries, and no unfair encouragement for exports. So these are general principles that, based on our economic theory, would make the world a better place economically. So what are the key WTO activities? It's a forum for multilateral trade negotiations. And as you might guess, these negotiations are not always successful. The most recent round, the Doha round of negotiations, have been suspended and continue to have problems. They administer trade agreements. They process for settlement of trade disputes, set up the process for settlement of trade disputes, and periodic trade policy review of each member country. So those are the main activities. They've got some new areas, though, that they're focusing on. Protection of intellectual property. That's found within the Agreement on Trade-Related Aspects of Intellectual Property Rights, or TRIPS. Also a General Agreement on Trade in Services. So GATS is the acronym there, General Agreement on Trade in Services. So rather than products, we're looking at services. This extends the WTO GATT principles to trade in services. So we're looking at multilateral sector agreements that we've seen in telecommunication services and financial services. So rather than just production, services that can be traded internationally. Finally, the World Trade Organization has dealt with a lot of dispute settlement among nations. On average, from 1995 to 2004, there were 32 cases per year. And since 2004, we've averaged around 17 per year. One or several member country governments can bring a complaint that another member country government is not abiding by the global rules. And so again, we had 161 nations that are members of the WTO. If a member nation is not abiding by the global rules, then other member countries can bring a complaint to the WTO. If negotiations between the countries cannot resolve the issue, a panel of experts hears evidence and then issues a ruling. Appeals are possible, but usually the panel ruling is upheld. And so that might be a reason why, since 2004, countries have kind of wised up that appeals aren't very successful. So there might have been a reduction in disputes since then as a result of that. So if practices or policies are found to violate global rules, the government can be requested to change or to conform to those rules. If the offending government does not, complaining governments can be authorized to seek compensation, including retaliatory penalties. The US has their Section 301 of the Trade Act of 1974 that also looks at trade disputes and provides for unilateral pressure. So this act gives the US president the power to negotiate to eliminate unfair trade practices of foreign governments. As we looked at the beginning of the lecture for Chapter 8, we discussed the US-China trade war, and the current president during this time is President Trump. and he is negotiating to eliminate what he terms to be unfair trade practices with China. Also, it can threaten to enact new barriers to imports into the US from the offending country. Also, the US government is much more likely to send a complaint to the WTO dispute settlement process. So we're always looking for fair trade, I'm guessing, at least trade that benefits the US. With that, that ends our discussion on non-tariff barriers to trade or to imports. If you have any questions, feel free to give me a call or shoot me an email, and be sure to read Chapter 9. Thank you very much.